Hey guys, JC Perez here, founder of AllStarCharts.com, and I am joined by my main man, Sean McLaughlin, my esteemed colleague. How are you, Shawnee?
Sorry, man. Just busy over here making trades, man. Fast market. You know how it goes.
Hedging trades, hedging trades. No, you're like, no, risk on trades, risk on, no hedging.
Hey, I was promised a big resolution type move in the market following whatever the Fed muckety mucks are doing today. And right now, I got to say, I'm pretty unimpressed.
I got to tell you, Sean, the market doesn't promise anything. So if you got people promising you things and telling you the market is going to do something, they are clearly very mistaken. There was once a time that I thought I knew what the market was going to do. And I was quickly humbled and humbled again and humbled again over many years until I finally realized that I do not know what the market is going to do next. We can look at the clues and we can identify opportunities where the risk is manageable and the potential reward for us taking that risk makes it worth our time and attention. And I think we have one of these opportunities now. We've seen a ton of relative strength out of communications in general. Meta's been the best trade we put on all year, right?
Look, Meta was a great trade. We got out of it today, by the way. Little breaking news for you. You probably didn't know that. Just a little while ago, we got out right before the Fed announcement. Actually, we got out. There was apparently some breaking news about some new rules about monetization. I don't know. I don't care, but the stock sold off quickly, like $5 right through my stop loss level. So we are out, but don't cry river for us, man. It was a great trade, probably so far our best trade of the year. So we are now out.
Well, Meta has had a heck of a move. You're seeing in communications in general, right? You saw it in Netflix, right? Monster move, one of the best trades we put on in the fourth quarter last year. Just technology in general continuing to push up against new highs. Both the S&P 500 and the NASDAQ 100 closing out April at the highest monthly close in a year. So to me, that's where the relative strength continues, right? And if you could position yourself with a favorable risk versus reward, I think it makes sense in that space continuing to rise. I like Google. People are talking about AI, who's going to win, who's going to lose, blah, blah, blah. Like, to me, let's look at who is winning and what is happening. And names like Microsoft, names like Google are acting well. So to me, if we're above that 109, 110 level, I think it's got a nice, is it $120 roll? Does that exist?
That's
$120
not a
roll?
thing, but nice try.
It's not a thing. All right, but that's where I think we go. Listen, those are back to the highs from Q3 last year. Those August, September highs in Google. That seems like a fair price target.
Right. The thinking here is once we get this Fed out of the way and we get earnings out of the way, if the next move higher, if the next leg or if the next leg in the broader market is higher, I personally have an incredibly hard time believing that Google won't at least break through last summer's high. I mean, how does it not happen if the markets are going up, right? And right now, and I wrote about it in the blog post, implied volatility in the options are making Google options very cheap right here. So when options are cheap and we're bullish, we love to go a little bit longer term, go a little further out in time, and just keep it simple and buy calls. And that's what we did. We bought the December expiration 120 strike calls, which have, last I checked, about a 35 delta. So they'll move pretty good if Google gets breaks out of this range here, breaks above that little gray area you've got highlighted around 109. If we break above that, those options are going to play well. And we talk about this all the time. I'm a broken record, but I just bought long calls. And so my best practice when I'm in that position is if it goes up, if it goes my way, I'm going to take half of that position off if the value of the calls double. I paid $6 for them today. So if I could sell half of them for 12, then I got a free ride all the way into December, and I like my odds in that scenario.
And I want to stress something. Originally when we were looking at this trade and we were talking about it, I was looking at a bull call spread, maybe finance that a little bit. And Sean's like, JC, volatility is, so low. What's the point? Just go out and buy the calls. There's no need to, right? Just buy the
Yeah,
calls,
look,
go out as far as you can. We can go out to December to the 120 calls. 120 gets us back to those Q3 highs from last year. And that makes sense.
yeah,
Just
and
want
look,
to walk through the thought process there.
yeah, you weren't wrong throwing out the bull call spread. That's a viable trade idea, and that trade idea would make sense for people in a couple scenarios. Maybe the first scenario being maybe they're just not comfortable laying out $600 for a call for one call contract. Maybe they're trading a smaller account. In that case, maybe putting out a bull call spread is a little bit more comfortable for your size of account. Nothing wrong with that. You'll still participate on the upside, and that's great. The other reason why you might want to do a bull call spread is maybe you just want to increase your odds of success. You're not so concerned about hitting that home run and participating in that potentially unlimited upside. You're more like, you know what? I just want to have a higher chance of success here. I want to ring the register. And in that case, maybe bull call spread makes sense. So it's not a bad trade idea. For me, I think buying the calls and getting ready for a big ride is a worthy trade here with vol being so cheap.
Yeah, and because it's a call option, you're a limited partner, right? You can't lose more than what you put in there. So, for me, when the risk is defined by definition, because literally it's what you paid for, you can't lose more than that. And then the potential gain is exponentially greater. It makes a lot of sense, but only in an environment where volatility is low enough to warrant a position that is not financed by the sale of another option, right? So there's a time and a place for everything. It's not just buy out of the money call options on any stock that you like at any time in any environment. It doesn't work that way. In this case, it's specific to a low vol regime where this particular strategy makes more sense, right?
Absolutely. And one thing we should also point out too, and this is confusing and this annoys the heck out of me, but Google also trades as Googl. There's Google and Googl, right? Now they pretty much trade 1-to-1 with each other price wise, but the difference being the Googl stock gives owners voting rights. That's really the only difference. But the Goog options market seems to have more open interest and more volume there. So that's why I chose the Goog versus the Googl, but either one would work fine. But if you're like me, you find this incredibly annoying.
Yeah, it's like you're like at a bougie restaurant. It's like, yeah, let me get the Google. Excuse me, sir, it's the Googl. Right? All right, so Google, we're buying the December 120 calls for approximately $6. If the price of the call option doubles, we're going to go ahead and take half off the table and let the rest ride with a free run. Can't lose at that point. But we've got till December. So check my math. What is that? 6.5 months? 7.5 months? About,
yeah.
Right? It's a long time. Long time. Yeah. Well-defined risk. I like this trade. If it doesn't work, can't lose more than what the call option, what we paid for the call option, but there's an exponentially greater reward, and we have till the end of the year. So I like this trade a lot, Shawnee.
Oh, final thought on that. You just reminded me real quick. 103 is the level I'm looking at as a stop loss. If we break below 103, which was the low early last week, it's a tight stop loss. But hey, if we're below that, I don't like the trade anymore, at least for now. So that's my stop loss.
And this is a great point, because what you're doing is you're adding a layer of risk management on top of an inherent layer of risk management, right? So it's like risk management on top of risk management. So in a worst case scenario, Google goes to zero tomorrow, you can't lose more than what you paid. So you already have risk management built into the trade. Now, on top of that, salvage everything you can. It's not a complete zero if you break below the recent lows. And this breakout is probably not happening, at least not anytime soon, and probably needs some further digestion or even a price correction in that case. So so you're minimizing your risk again there. I like that.
Yeah. All right, man. Well, hey, great hanging out with you in New York last week. Let's do it again.
Yeah, New York's a great city, man. It's a good time. Saw some good tunes. Went to Smalls, little late night jazz session. That was nice, right?
Way past my bedtime, but it was totally worth it.
Yeah, seriously, me too. All right, guys. JC Peretz here. Sean McLaughlin. Follow us on Twitter at OptionsSean. Follow me at All Star Charts, and we will see you next week.
Take care.
Adios.